As in the recent past, the Reserve Bank will continue to monitor the emerging situation and deploy all resources and instruments at its command in the service of the nation, especially for our citizens, business entities and institutions beleaguered by the second wave. The devastating speed with which the virus affects different regions of the country has to be matched by swift-footed and wide-ranging actions that are calibrated, sequenced and well-timed so as to reach out to various sections of society and business right down to the smallest and the most vulnerable. The first measure relates to term liquidity facility of rupees 50,000 crore to ease access to emergency health services, to boost provision of immediate liquidity for ramping up COVID-related healthcare infrastructure and services in the country, and on-tap liquidity window of rupees 50,000 crores, rupees 50,000 crore with tenor of up to 3 years at the repo rate is being opened till March 31st, 2022, that is March 31st of next year. Under the scheme, banks can provide fresh lending support to a wide ranging of entities including vaccine manufacturers, importers and suppliers of vaccine and priority medical devices, hospitals and dispensaries, pathology labs, manufacturers and suppliers of oxygen and ventilators, importers of vaccine and COVID-related drugs, logistics firms and also patients for treatment. Banks are being incentivized for quick delivery of credit under the scheme through extension of priority sector classification to such lending, and this facility will be available up to 31st March next year, that is 31st March of 2022. These loans will continue to be classified under priority sector till repayment or maturity, whichever is earlier. Banks may deliver these loans to borrowers directly or through intermediary financial entities regulated by the Reserve Bank of India. Banks are expected to create a COVID loan book under the scheme. By way of an additional incentive, such banks will be eligible to park their surplus liquidity up to the size of COVID loan book with the RBI under the reverse repo window at a rate which is 25 basis points lower than the repo rate, or termed in a different way, that is explained in a different way, 40 basis points higher than the reverse repo rate. So this is an additional incentive that is being given to the extent that they are using this window and they are lending, and to the extent that is available in their COVID loan book which they are going to create. Whatever is the loan disbursed under that window, equivalent amount they can put it in reverse repo at a rate which is 40 bips higher than the normal reverse repo rate which prevails today. Second measure, the next measure relates to special long-term repo operations, SLTRO, for small finance banks, SFBs. Small finance banks have been playing a prominent role by acting as a conduit for last mile supply of credit to individuals and small businesses. To provide further support to small business units, micro and small industries and other unorganized sector entities who are adversely affected during the current wave of the pandemic, it has been decided to conduct special 3-year long-term repo operations, that is 3-year SLTRO of rupees 10,000 crore at repo rate for the small finance banks to be deployed for fresh lending of up to rupees 10 lakh per borrower. This facility will be available till 31st October 21. Lending, next measure relates to lending by small finance banks, that is SFBs, for on lending to SFBs for on lending to MFIs to be classified as priority sector lending. At present, as you would be aware, lending by small finance banks to microfinance institutions for on lending is not reckoned for the purpose of priority sector lending classification. In view of the fresh challenges brought on by the pandemic and to address the emergent liquidity position of the smaller MFIs, SFBs are now being permitted to reckon fresh lending to smaller MFIs with asset size of up to rupees 500 crore for on-lending to individual borrowers as priority sector lending. This facility will be available up to 31st March 22. Next announcement relates to credit to MSME entrepreneurs. With a view to incentivize credit flow to micro, small and medium enterprises, that is MSME borrowers, in February 2021, the scheduled commercial banks were allowed to deduct credit disbursed to new MSME borrowers from their net time and demand liabilities, that is NDTL, for calculation of their cash reserve ratio, CRR. In order to further incentivize inclusion of unbanked MSMEs into the banking system, this exemption, which is currently available for exposures of up to 25 lakh and for credit disbursed up to fortnight ending 1st October 21, is being extended till 31st December 21. The next measure relates to Resolution Framework 2.0 for COVID-related stressed assets of individuals, small businesses and MSMEs. The resurgence of COVID-19 pandemic in India in recent weeks and the associated containment measures adopted at local and regional levels have created new uncertainties and impacted the nascent economic revival that was taking shape. In this environment, the most vulnerable category of borrowers are individual borrowers, small businesses and MSMEs. The following set of measures are being announced today, specifically targeting these groups of borrowers, and this particular set of announcements, there are three components to it. The first component is as follows: borrowers, that is individuals and small businesses and MSMEs having aggregate exposure of up to rupees 25 crore and who have not availed restructuring under any of the earlier restructuring frameworks, including the Resolution Framework 1.0 of RBI dated 6th August 2020, and who were classified as standard as on 31st March 2021, shall be eligible to be considered under the Resolution Framework 2.0. Restructuring under the proposed framework may be invoked up to 30th September and shall have to be implemented within 90 days after invocation. In respect of, and the second component, now I am proceeding to the second component of this set of announcement. In respect of individual borrowers and small businesses who have availed restructuring of their loans under the Resolution Framework 1.0, where the resolution plan permitted moratorium of less than 2 years, lending institutions are being permitted to use this window to modify such plans to the extent of increasing the period of moratorium and or extending the residual tenure up to a total of 2 years. Other conditions will continue to remain the same. And the third component relates to small businesses and MSMEs which were restructured earlier, and this measure is intended to ease their working capital accommodation and the working capital availability for small businesses and MSMEs. And the announcement is as follows: in respect of small businesses and MSMEs restructured earlier, lending institutions are being permitted as a one-time measure to review the working capital sanction limits based on a reassessment of the working capital cycle, margins, etc.